Okay, people are joining quite quickly now, so give another 60 seconds or so, and then I think we'll start quite promptly at 2 minutes past 10. For those of you who have just joined us, you can see on the shared screen, we've got the Mentimeter code again that you would have seen in the first module. If you can please, probably best use your personal phones, but log on to Mentimeter again. We've got a couple of polling questions and enter that code. And so when the questions come up, you'll see them directly on your phone. Okay, we're still waiting for some people, but I think in the interest of time, let's kick off directly. Bianca, if you would like to switch to the main slides. Welcome everybody. Good to see a number of your faces. Good to see videos on. I hope. Well, let's see the slides and then we can kick off. Excellent. So good to have you all back. A few people might come in dribs and drabs now over the next couple of minutes, but I think let's get started. So we're now into week 3, module 3 of the program, almost halfway through already. Thanks all for starting on module 2. Ideally, I think we would have had most people completed by now, but I think a lot of people have started and made some progress, but have not yet completed it. So I think that's fine. Please do, though, complete it before the end of the program, because obviously that's necessary to get your completion certificate. So please put some effort. We recognize that it's obviously quite hard to fit doing the module 2 alongside really busy day jobs. That is clearly challenging, but you know, we recognize that, but if you can't put some extra time in dribs and drabs over the coming weeks to complete that, that'll be really valuable and necessary to get the kind of certificate of completion. So module 3, we start the program. I don't need to go into more detail of introductions and so forth. So I'm just going to introduce the speakers that we have joining us today. Again, I'm going to chair the session and take questions and help facilitate and keep people to time. That's always a challenge when you're online. So we're very lucky to have 2 internal speakers. We've got James Wild, who's the head of sustainability within the group function, and he's going to spend a bit of time in the first session providing an overview of, you know, why the commercial, well, not the commercial bank, but why Lloyds Banking Group sees sustainability as being strategically important and some of the different initiatives that are happening across the broader organization. And he also touched on briefly, you know, what operationally Lloyds is doing to tackle its own operational footprint, recognizing that obviously your greatest impact and influence that you have is in the way you choose to deploy your capital, and that's hence why we're engaging all of you in your client-facing roles. So James will provide a bit of an overview of the group and what's happening there. We'll then move on to Gary. So Gary is your head of responsible business. Many of you probably know him already, and he's going to provide a bit of an overview of what's happening in the commercial bank and some of your ambitions for the future. On this first program, the Sustainable Business Program, we launched the Clean Growth Finance Initiative, and that's obviously some time ago, and I think most of you are now familiar with that. And we spent more time then explaining what that proposition was about, but I think a lot of you already know that. And so Gary's just going to give a broad overview about the commercial bank and the kind of direction of travel. And then we're going to move to James Stacey. James Stacey is a partner at ERM and also a long-standing fellow of CISL. And he's a kind of key external speaker for today. And he's going to dive more deeply into, you know, what are the commercial implications of the changing context. We had Tony in module 1, who kind of, I guess, really, well, hopefully tugged at some of your heartstrings, gave kind of the ethical and the moral case for reaction. Some of you might still be skeptical about the commercial case. Hopefully by the end of today, you'll have a clear sense that actually there are real strong commercial drivers for making change. And James Stacey, by way of introduction, he's been working within this space for the last 25 years, both in kind of corporate strategy, mergers and acquisitions, and kind of risk management. And he's also been working quite closely with the commercial bank in various roles, particularly focusing on some of your work around the task force for climate-related financial disclosures. It's a bit of a mouthful. TCFD, many of you probably may have heard of it, some of you may have not, but James will touch on that briefly, and we'll also pick up in more detail on that tomorrow. So that's a brief overview of the speakers, and partly I've already covered off what we're going to be doing in the agenda. So probably 10 minutes or so from James Wild and Gary Lapthorne, then a bit of time to break for Q&A. I will invite you to come off mute if you want to ask them questions directly. But also please add questions as you go through, as we go through to the chat function on the right-hand side. And as we did last time, it would be great if you can like questions that you think are particularly interesting or you'd like to have answered. And in that way, we can get them prioritized. And I've asked James and Gary to potentially, if they can, answer some of the questions that come up in the chat function. Maybe they can answer them via the chat. Otherwise, we can pick up those questions in the Q&A. I'm then going to hand over to James Stacey. He's got about 30 minutes. We've got a few couple of polls inside there. I might take some Q&A as we go along through that session just to break it up a bit. But hopefully then we also got a good chunk of time for Q&A at the end before a brief wrap up and close. So that's the process for today. Very briefly, I just want to kind of spend a minute going through the kind of the overview of the program, just to orientate yourself. It's sometimes difficult to kind of lose sight of the program or where you are in the learning journey, particularly when it's kind of broken up into multiple chunks as it is as part of this program. So we had the global pressure and trends as part of module 1. We're now into the second bit element there around the really diving deep into the commercial implications. And you'll hear from James, and we'll be talking about some of the niche disruptions and new opportunities that are coming up that are creating either risks or opportunities, depending on whether you're an incumbent or not. But also we're having significant landscape level disruptions. These are all terms I introduced in the welcome video, but the likes of COVID, some significant macroeconomic disruptions as well. And so James will start picking up on some of these commercial implications. Before tomorrow, we'll go into a bit more detail around the niche disruptions and some of the climate change risks. And that will set us up then for next week, where we go to look much more deeply at, what does this mean for your clients in the real economy? What does good look like? And try to give you some tools to help think through that. So very brief overview. If you have more questions on that, I can happily answer them via the chat function or via the discussion forum on the online campus. So James Wilds, I can welcome you now to give a few slides, and we can hand over to you to kind of give an overview of what the group is doing and how they're thinking about some of these challenges and kind of sustainability more generally, both from the kind of risk side and increasingly also the opportunity side. So over to you.
Excellent. Thanks, Thomas, and real pleasure to join you all today. My name's James Wild, as Thomas said. I joined the group about 2 years ago to basically help develop a sustainable finance strategy for the organisation. Having worked in the climate change arena for probably 15, 20 years, an awful lot with international governments around the world and financial institutions, both at the policy level, but then also in developing new business models and financing mechanisms to unlock the prize of related to climate change, which we'll hear much more about in the session today. If we flick to the next slide, this really starts to highlight why, as a group, we're taking action on sustainability and climate change. There's a whole series of drivers for action, and the most important, in a way, is the fundamental shift required in the economy. There's a group of scientists that look at the available evidence on behalf of governments, the IPCC, and they've said that there needs to be a 45% reduction in CO2 emissions by 2030, and for the whole global economy to get to net zero by 2050. That is a fundamental shift in the way we live and work, and it implies an awful lot of investment. So if you just look at the energy sector, for example, we're talking about 3.5 trillion global investment in energy per year, and that's double the current rate. As a bank, that creates a real opportunity. There is a very significant need to finance the transition to a low carbon economy. And that's one of the reasons I've joined Lloyds Banking Group, given its very substantive role in the UK economy. Increasingly in the international space, there's focus on the role of banking. And indeed at the COP this year, where we expect finance to be one of the four key themes of the negotiations, and expect the profile of finance in this transition to increase significantly. As a consequence, our competitors are really ramping up their game on sustainable finance. You'll see, particularly internationally, a whole series of both commitments to finance the transition. A number of financial institutions have said they'll they'll provide over £100 billion of green finance over the next 10 years, as well as a whole series of specific green finance propositions. So this is a competitive need as the economy transitions, and there's significant investment requirement. Moreover, investors are taking this issue extremely seriously. On my second day after joining Lloyds Banking Group, I had to go and meet Legal & General, who'd just written to the chairman saying that Lloyds wasn't doing a significant enough job on this issue, and they would move to get him removed as chairman if the story wasn't improved. And they had actually divested from a number of large multinational organizations on the basis of their climate change performance. BlackRock, another really big, important global asset manager, wrote to the companies they invest in saying, we expect you to implement the TCFD, which we'll hear much more about, and other ESG related reporting guidelines. So investors are putting an awful lot of pressure on firms to have a good story on climate change. NGOs and activists, I mean, the case is so extreme that people often talk about a climate emergency, and the next 10 years is when we need to act. And because of the importance of financial institutions, NGOs really target banking groups. A nice example of that is that Barclays AGM, not this year, the year before, when it was in person, was stopped by a group of activists in the middle of the CEO's speech. A number of organizations track the investments and lending of financial institutions and almost have a blacklist of those that are supporting fossil fuels. So they're putting a lot of pressure on banks to do the right thing in terms of financing the transition. And we as an organization have made a series of existing commitments. And if we don't live up to those, that creates reputational risk. But quite fundamentally, the government are taking this really seriously in the UK. The UK is leading on this issue. We were the first developed economy to set a net zero goal or a zero carbon goal for 2050 in law. Also, the regulator is taking a leading role. They're very much leading the way on requiring banks to embed climate risk into their risk management processes and implement the TCFD, which James and others will tell you more about. So there's a real push from the UK government. They've launched a clean growth strategy, and there's a really nice mirror to our organisation and the different parts of our organisation and the sectors that we feed into. So if we go to the next slide, I can say more about what our strategy is at the highest level. So we've said that we want to be a leader in financing the transition to a sustainable low carbon economy. And to create a framing around that, we've set out a goal around our financed emissions. As Thomas said, the financed emissions are far more significant, order of magnitude more significant than our in-house footprint. And we said that we want to help reduce the emissions we finance by more than 50% by 2030, in line with the UK's goal to be net zero and the Paris Agreement and what the scientists said on that previous slide. And we said there's 4 key principles to getting to that goal. The first is identifying opportunities to support our customers and clients in the transition. The second is taking a strategic approach to risk and disclosing these in line with the TCFD framework, which others will tell you about. The third is using our scale and reach to help drive progress. I think what's really important to realise here is that a number of the policies that are required to make this opportunity investable, and some of the technologies and some of the business models and that customer demand isn't quite there yet in terms of getting to that full transition, that 50% reduction in the next 10 years. So it's really important that we leverage our understanding of the market and our position in the market to help inform the change. And we're actively doing that, both in the context of the green recovery. We've been talking to every part of government around how they could stimulate investment in the clean transition as part of Building Back Better. And then in specific areas of policy development. A nice example is in SME energy efficiency, where we've been working very closely with the government on how they might evolve policy to make it more financially attractive and easier for SMEs to invest in energy efficiency. And finally, if we're out working with our customers and with the government and other stakeholders, we need to be credible. So it's really important that we embed sustainability in the way we do business in terms of our operations and our supply chain. So to support our ambition, very much anchored on that kind of UK government clean growth strategy, we've set out 7 leadership ambitions. The first is being essentially a leader in financing clean growth in the business sector, and Gary will say much more about that. In homes, where we've got Halifax, and our mortgages, we want to be a leading provider of energy efficient, sustainable homes. In vehicles, where we've got both Lex Auto Lease and Black Horse Finance, and we finance over 1.2 million vehicles, and we have the largest low emission vehicle fleet in the UK already. We want to be a leader in providing low emission green vehicle fleets. In pensions investments, where we've got Scottish Widows, we want to be a leader in providing offers to customers and colleagues in terms of sustainable investment choices, and really challenge the companies we invest in to behave more responsibly and sustainably. In the insurance space, where we're the leading insurer of homes, we move on to the kind of physical risks of climate change. And flooding over the last couple of years has been a really big issue in the UK. There, we want to really improve the resilience of customers' lives against extreme weather caused by climate change. Green bonds is the next big theme, and two angles to this. One is issuing bonds on behalf of our clients. The other is issuing bonds on behalf of the group to finance the activities above. And as I've mentioned, the final ambition is around our own footprint, being leading in reducing our own internal footprint and that of our supply chain, the goods and services that we procure. So there are our ambitions. On the next slide, I've indicated some of the successes since we started and got the strategy signed off in October 2018. By the end of 2019, we'd actually made some really lovely visible examples of leadership, and this is very much a cross-group effort. In business, the CGFI, which Gary will talk about a lot more about, has kind of really led the way, and the work in the commercial division. And there's some lovely examples, everything from the small SME that's developed a sustainable T-shirt to the world's largest offshore wind farm. So really great leadership by example in the business sector. In homes, we've created a green energy hub on the Halifax website with lots of tips and tools for energy efficiency for first-time buyers. And we have some really interesting plans going forward to create green mortgages for our customers. And I'll talk a bit more about that in a moment. In vehicles, we signed up to EV100, which is a commitment to have our total fleet net zero by 2030. But really important in 2019, we had a programme where we gave a £1,000 discount to the first 1,000 customers last year that were buying electric vehicles. That means we funded 1 in 14 electric vehicles in the UK. It gives a sense of our scale and our ability to change the market. In pensions and investments, we joined a shareholder resolution to ask Shell and BP to articulate a long-term climate change compliance strategy. They got passed, so that's really quite fundamental for those really big organisations. In insurance, we've actually got a really fantastic, dedicated team that are experts in extreme weather and climate change. So we've been leveraging that and actually working with universities to extend the thinking on that. And we were the leading financier of issuer of green bonds in the UK for UK corporates, as well as creating a sustainable bonds framework, which will enable us to issue bonds on behalf of the group. And in terms of our own footprint, we've made great progress too. We've signed up to the Climate Group's 3 programs around renewable energy, where we're already 100% renewable. EV100, which is about moving to 100% electric vehicles for our own fleet, and we've rolled out 30 charging points. And then EP100, which is about improving our energy productivity. And we've rolled out an energy management system and a whole series of audits and tactical energy efficiency opportunities across the group. And we've had a big campaign on waste, and we've reduced single-use plastics by over 40 million items. So some really great progress. On the next slide, this last year, since 2019, has obviously been disrupted by COVID, but there's a really strong narrative around building back better and a green recovery. And we've launched 5 propositions this year in the context of green recovery. A home energy efficiency tool, which enables customers to work out how they can improve their home. I'd encourage you to go on the Halifax website and have a look at that. And there's going to be a campaign on the Interchange site on that coming up very shortly. An equivalent tool for commercial real estate, which Gary will talk more about. A salary sacrifice scheme for electric vehicles, very much like the bicycle scheme, which enables customers to get tax break when buying electric vehicles. A sustainable agriculture proposition, which I'm sure you'll hear more about, but it has a really nice link to our Woodland Trust partnership, where we're going to plant 1 million trees a year for the next 10 years, because 70% of the UK landmass is owned by farmers, and so they have a really important role in terms of reforestation and planting hedgerows. And in the Scottish Widows world, the default pension is the thing that matters. 94% of people just keep their money in the default. We have a £33 billion default that has 1.2 million customers' pensions in it. And what we've done is become a founding supporter of BlackRock's new Climate Transition World Equity Fund, where we've allocated £2 billion to that new fund as part of our default. So some really nice examples of leadership already this year as we move out of the COVID situation, hopefully. In terms of improving our own operations, we've got a great story too. We've hit all our targets, or very much on track to hit all our existing targets. A nice example is we said we wanted to reduce our emissions by 60% from 2009 to 2030. We've already hit that. So at the moment, we're working out a new target and set of goals, really with the focus on being zero carbon without offsets is the current goal. And we're looking at the new ways of working introduced by COVID to really work out how ambitious we can be in that new goal. But we're looking to set out a really ambitious future strategy around our in-house footprint. Going to the next slide. And then very quickly, what's lovely is we've had a lot of recognition for these accelerated efforts. In these presentations in the past, I've always started with this chart on the left-hand side around one of the reasons to act. One of the NGOs, Share Action, ranked all of the top 15 banks in Europe on climate change, and Lloyds in 2017 came out bottom and was positioned as a laggard. And as a result of our financed emissions target, our strategy, and the great progress we've made in developing propositions, particularly in the commercial bank, when Share Action repeated that review at the end of 2019, we came second in that chart on the right-hand side, if you could see it, and positioned as a leader, and only a kind of a fraction behind the leader across all of Europe. So really, really great progress. We're also the only bank to get on the CDP A list in 2018 and 2019 in the UK. That's quite an objective analysis of all corporates, large corporates, performance on climate change. So to get on that A list, that leading list, is really very difficult. So that's a fantastic example of the progress we've made. And then finally, on the last slide, I just wanted to highlight the governance around this. This is strategically a really important issue, and it's got very high exposure, and it's very well structured, the governance and within the organisation, and you all know how important that is. This goes all the way up to the board. There's a responsible business committee that spend more than 3 hours specifically on climate change every 6 months. There's a GEC sustainability committee that meets every 2 months for 2 hours, talking in detail through the strategy and the progress against it. We have a very small central team, but a lot of the real work is done within the divisions. In each division, we have an MD sponsor and lead, and a working group. We have a forum, and I think there's more than 40 people that come together that really look at synergies across the group, and talk through progress. And then specifically for risk, we have a TCFD working group, which has been renamed Climate Working Group. And the work on climate risk goes up through the related governance for risk, as well as being fed through this the governance framework you can see here. And I think the key message from this is the board, whenever we talk about this issue, always say, go further, go faster. As we look at the kind of next strategic review and the positioning around what's Lloyd's role in society of the future, sustainability is coming through as a really key theme. And so we're actively working with the strategy team as to how we can take this forward and actually increase our ambition in this area. So that's my quick summary of the overall strategy, and I'll hand over to Gary to talk about the commercial division.
Great, thank you, James. Yeah, Gary, I think if somebody could put themselves on mute, I hear a bit of echo in the background. Gary, over to you now. I think we've got kind of 10 minutes to keep us to time, so if you can trot through your slides to get us done by 10:35, that would be great. Oh, you're out there, Gary. You might be on mute. I did see you respond to a question, so you must be there somewhere.
Can you hear me now?
I can. Welcome. Yeah.
Thanks, Thomas and James, and good morning, everyone. This is a section that we used to spend a lot more time on in the programme, but I think a reflection of the progress that James has just been describing is that we can go through this quite quickly, because I suspect a lot of it will be quite familiar to many of you on the call. So if we could go to the first slide, and what I'm going to try and do is just bring things a bit closer to home and maybe a bit more up to date in terms of why this topic was and remains so relevant to us in commercial banking, and kind of there's an element to this which is BP or before pandemic, and then reinforced a bit in terms of after or during the pandemic. James threw some numbers at you in terms of global investments needed, and in terms of the UK, the Committee on Climate Change recently estimated that reaching net zero will involve about 50 billion of capital a year in the UK flowing into greener activities. And there was a similar estimate, but actually a higher one from the Government Department of Business, Energy and Industrial Strategy, which put the number at nearer to 70 billion. Either way, there is still a huge need for capital to flow into these kind of investments. And more on the risks side of the equation, I guess, this is relevant both to us as an organisation and of course to our clients, but there are a number of areas of risk which I think James will unpick a little bit later in the session. But just to kind of thumbnail through them, we and our business clients all experience an exposure to physical risks, the risks that our businesses may be disrupted as a result of physical events arising from climate change. Secondly, transition risk, which is often linked to regulatory changes. And, just in terms of our own position, we've seen last year the Bank of England published their supervisory statement about enhancing banks and insurers' approaches to managing the financial risks arising from climate change, and to commit that they'll use their biennial exploratory scenario next year to test our resilience to different climate pathways. And just in a similar way, our clients experience these potential transition risks that regulation will change and impact the way that they will need to operate and manage their businesses. And then finally, of course, there's liability risk, often linked to reputation, and that risk that people will choose to withdraw from clients and withdraw from purchasing from businesses that are seen to be part of the solution rather than part of the problem. And bringing that kind of up to date in terms of during the pandemic, in the relatively early stages of lockdown, the Ipsos Mori poll you can see here got a response from about 2/3 of people in the UK saying that their view was in the long-term climate change is just as serious a crisis as the pandemic is in the short term. And it wasn't long into the pandemic before we started to see a real increase in calls for a green recovery and the importance of not losing our traction and momentum on addressing sustainability and climate. And the group, as James alluded to, also added its voice via Antonio to one of the letters that was signed by multiple business leaders. So if we move on to the next slide, I guess very quickly, just a reminder of some of the key ways that this is affecting, our clients. So premises is a great example because it's estimated that up to 40% of the global emissions arise from the built environment, and pretty much all of our clients operate from somewhere. Similarly, transport, the vast majority of our businesses in the UK need to move people or goods or something from A to B, and that sector contributes individually the largest amount of emissions in the UK. Just under a quarter of total emissions arise from that sector. Thirdly, in terms of costs, the raw materials that we use become ever scarcer, as was amplified, I'm sure, in Tony Juniper's presentation on your opening module of this programme. And so the way that we use energy and water and other scarce materials can either become a competitive advantage or a competitive disadvantage for our clients. Workforce is a really interesting area. It's perennially been one of the hottest topics in terms of attracting and retaining skilled workforce for businesses in the UK. And over this next decade, it's estimated that the clean economy is going to require about 4 times the amount of people in it compared to today. So estimated that it will rise from about 500,000 jobs to nearly 2 million by the end of this decade. Similarly, in the clean growth strategy, the UK government estimated that the clean economy could contribute up to about 170 billion per annum to export markets by the end of this century. All of which means that, in this scenario, whilst we talk a lot about the risks, there are a huge amount of opportunities for our clients that get this right. Moving on to the next page, James said that commercial banking has been sort of front running this strategy. We started our initial thinking on it in 2017, and we're kind of first out of the blocks in 2018 with the bold statement that we wanted to be, you know, a leading UK commercial bank for sustainable growth. And at that point, we outlined our strategy on 3 pillars, which pretty much endure today in their same format. So we decided we were going to invest in colleagues. We wanted to continue to make a number of ambitious commitments to our markets, and we wanted to use our voice where it makes sense to do so to visibly support the transition. If we now move on to the next slide, here's a few examples of the credentials that we've built over those last 3 years. And in relation to that first pillar, we've now got over 640 people trained by this programme, and that will increase by about another 150 to 200 as a result of the online modules that you're now participating in. In terms of our ambitious commitments, we have now helped to power over 6 million homes with renewable energy through our support for those transactions, improved over 19 million square feet of real estate, and since 2016, we've now delivered around 6 billion of green finance to our clients. And then finally, in terms of visible support for the transition, we've invested in supporting our clients, and it's a fact that many of our clients are just as keen to publish their case studies and show how they've used green or sustainable finance to improve their business models, which is obviously good for them and good for us as well. On the next slide, just wanted to highlight that we now have a broad portfolio of green financing products. As James said, they range from our Clean Growth Finance Initiative, which starts with the smallest of our SMEs and supports all the way up to the largest renewable energy transactions. But we've also in that portfolio got bonds. We have piloted this year a sustainable fixed term deposit. We'll talk a little bit more about the green buildings tool and the agricultural proposition, but we also have started seeing real growth in the sustainability linked loans market. And as we think onwards, there are still 1 or 2 ideas which we're exploring at early stages to help us to make this portfolio even more comprehensive as we go into the Strategic Review 21 period. So moving on to the next slide, I just wanted, I guess, to re-emphasize that, whilst we naturally paused our training in the early stages of the pandemic, when, we were all focused on client outreach and just supporting our clients and our people through the implications of the vast changes we all experienced. Nevertheless, in the background, we were able to progress our important partnerships with CFP Green Buildings, and with ITT Hub, which is a really important partnership in the transport sector. But we were also seeing clients draw down under our green finance propositions. And as James said, it was good to see the group being recognised for the progress that it had made. And I think importantly, Antonio, using the majority of his speech at the AGM in April to re-emphasize our long-term commitment to launching more products, more services to support businesses financing their investments in the green economy. So moving on to the next slide, that had us in the sort of latter part of H1 doing a bit of a replan in terms of the key priorities for the remainder of this year. I'm not going to drain this one, but just to emphasize some of the key points. Obviously, we've repackaged the training program, and hopefully we'll get some good feedback from all of you in terms of how this is working as an online delivery, because that will certainly be our approach for the medium term, I suspect. In terms of our ambitious commitments, we continue to think about how we build take up of our green finance propositions beyond the initial 3 billion that we have committed. We have more work to do in terms of building our green pricing model and how we continue to enhance the transparency in our portfolio. And of course, a lot of time, as we've said, thinking about our Strategic Review 21 and Society of the Future enhancements to our propositions. We've also reaffirmed our commitment to sector leadership through some of the partnerships that we've worked on, and a new one that we're at the early stages of exploring is in relation to the circular economy, where we're in early stage discussions with the Ellen MacArthur Foundation about how we can work with them to help more of our clients have an approach to circular economy and how we can finance their investments to do so. Onto the next page. You'll see much more about this, no doubt, over the course of the programme, but Green Buildings Tool is a critical investment for us. It is incredibly intuitive. It's exclusive to Lloyds in the UK, as you, I hope, know. The key thing is how beautifully it works with the green recovery message, because it helps clients to build ready-made business cases for how they can make investments in improving their built environment that will yield cost savings, sensible payback periods, and of course emissions savings. So it's that real sweet spot of actually making investments that set your business up to be more sustainable and more cost effective in the future. Next slide is a quick reminder of the improved agricultural proposition, which we launched earlier this year with Lee and the team. Some really important steps forward here, and at a time when the team were telling us they needed a change in dialogue. They were ready for actually a change moving on from the discussions about pandemic support. And of course, this is a really comprehensive proposition which ranges from specialist sector training for our people, again with support of Cambridge and others, some enhancements to our clean growth finance criteria to really tailor it to the sector, re-emphasising the opportunities for tree planting under the Woodland Trust Partnership, both in terms of the subsidisation of that, but also the improvements that can make to protection of land, protection of crops, protection of livestock and biodiversity. And then, our partnerships with these three carbon calculators, given that 9 out of 10 of the agricultural clients were telling us they didn't currently measure or baseline their carbon footprint. So we're now able to help them do that. And then we're going to continue that dialogue with regular sustainability sessions, which Lee and the team delivered the first one of as part of the launch. So a real commitment to what is a critically important sector to the economy, and one, of course, in which we are extremely well represented and strong in terms of market share. And then on to the next slide, just a reminder that we kind of have good governance on the commercial banking side. We have a monthly leadership group. We have sponsorship in terms of Scott Barton and Judith Butler, but also really strong and close sponsorship from David Oldfield, who we sit down with at least once, but often more times per quarter, to go through the whole of the programme and deliverables. So you've got real leadership and support from the top in terms of this programme. And then, finally, a kind of a bit of a view forwards on the final slide, please, which is how we're starting to think about 2021 and beyond. And it's a very natural evolution of the three pillars. We see a continuation of managing the portfolio towards green through a mixture of the propositions for green finance and the sector statements and policy and appetite statements that will support us to take more of our portfolio away. Echo on the line. Away from less sustainable activities. We'll continue to build those tools and propositions. We will continue to support the transition in strategic sectors, typically energy, agriculture, real estate, circular economy, and so on. And then we will continue to be more visible in terms of the market for sustainable finance through our thought leadership publications and the innovation and the partnerships that we've built. So I didn't quite hit your 10:35 threshold, Thomas, but hopefully that's a useful canter through the commercial banking strategy.
Yeah, thank you, Gary. No worries. I will forgive you. You'll be pleased to know. But I think what we'll do is this. I see James and you have both been responding to some of the comments that are coming up in questions. So there's a few in there, Gary. When you've got a moment while I hand over to James to kind of start in his section, it would be great if you could respond to some of your colleagues' and the questions, some really valid questions coming through there. So instead of taking questions directly now, I understand that both of you can hang around to the end. So I'm going to invite James Stacey to kind of give his session, and then we can hopefully spend a bit of time then at the end coming to any kind of questions via kind of, you can express them verbally by coming off mute. So James, over to you. The hard task, obviously, keeping to time. I know you've got quite a bit of material to get through, so yeah, feel free to fire away. Thank you.
Brilliant, thank you. Great presentations, James and Gary. And having been involved in these programs for a number of years, to see the enormous improvement in terms of Lloyd's position vis-a-vis other banks, I think is really impressive and testament to the priority and significance the organisation's given this agenda. Just a couple of quick introductions. I'm Global Director for Climate Change and Low Carbon Economy at ERM, which means I've got worldwide responsibility for how we work with clients in this space. This agenda now comprises quite a significant part of our business. We're just short of $1 billion turnover, operating in about 45 different countries worldwide. I was previously Global Head of Sustainability at Standard Chartered Bank, so very familiar with the world that you're operating in. Earlier, I ran KPMG's UK sustainability consulting business and spent just short of 10 years in private equity, investing in clean tech and clean energy infrastructure. So the objective of this session really is to run through some of the commercial consequences that your clients will be grappling with around this agenda, and really to prompt thought around what that might mean then for risk and for opportunity for you as a service provider into those organisations. Just a quick time check, Thomas, before I dive in. Am I still aiming to finish at 11 o'clock or is it still 30 minutes, just so that I can gauge time as I go? You're on mute, Thomas, so I can't hear you.
Apologies. Yeah, if you can aim for sort of just after 11, so if you can try to keep things quite dense so we can have some good Q&A afterwards, that would be great. So just after 11, I know that's quite quick. Some of the material we'll be picking up, particularly on TCFD and some of your latest slides in tomorrow's session, so you can move through those quite quickly.
No, that's helpful. Yeah, I can try and speed up. Okay, so just some contextual setting, really. I think we've heard from other speakers, and you probably heard from Tony when he spoke, that the UK has a net zero commitment 2050. Previously, that was 80% reduction in emissions, but got ratcheted up in the final act of the May administration, with a whole range of different strategies and actions now being rolled out by UK government, which of course create risk and opportunity for UK business as UK companies seek to navigate that change. If we move to the next slide, we'll see the kind of carbon intensity of the UK economy expressed in financial terms. So what this plot is showing us is the greenhouse emissions intensity of the economy, of GDP, expressed in US dollars. So if we go back to 1990, you can see that there were 800 grams of CO2 emission of GDP in the UK economy. And of course, net zero means that we're aiming towards zero. So just to give that a little bit of context, back in 90, that means that we had greenhouse gas emissions equivalent to the weight of a bottle of wine per every $1 US of GDP. That's quite a substantial weight if you imagine holding that in your hand, a bottle of wine for every dollar, and we're going to zero. So this is an industrial revolution. We are well into that journey, though the first part of that journey was pretty straightforward. We changed our power generating fleet from coal to gas, and we've offshored an enormous amount of heavy industry to China and other parts of the world. And with that, emissions have been removed from the economy. So this next part of the journey will be much more significant and have much more bite to it in terms of what it means for UK business going forwards. And so if we click on then, Bianca, just to think about what are the different ways in which business will be affected by this agenda. And there are 4 key themes that we tend to talk about here in terms of the low carbon economy journey and the physical climate change that we will face. So first of all, that physical climate change, and I'll touch on a couple of examples later of how physical climate change is affecting companies and creating commercial consequence. Then the transition drivers, that decarbonisation of the economy, and how that manifests itself through policy, through technology shifts, through market shifts, and how those different drivers are affecting different organisations that have high carbon emissions, but in many cases organisations that have very low or no carbon emissions, but they have a dependency in their value chain on carbon somewhere. Then we have legal liability. No outstanding examples of this yet in the UK, but PG&E, one of North America's largest power generating and transmission companies, filed for bankruptcy last year because of an association between their transmission lines and the forest fires of California of 2 years ago, and the litigation that followed. So legal liability now very much on the radar, certainly for investors in terms of how they are evaluating organisations' exposure to this agenda. And then finally, reputation issues, particularly relevant for business to consumer companies where, as we've seen, consumers are becoming much more alert to these issues and beginning to start to make choices that might be driven by this agenda. And so we've got a whole host there then of commercial outcomes, whether it's assets that are stranded, markets that are being disrupted, macroeconomic and local economic impacts, etc. And I'm going to seek to touch on a few of those in the time that we've got together now, going through the deck. So if we move forwards, Bianca, to the next slide, carbon pricing, an issue that the companies all around the world are now starting to need to grapple with. The map of the world there shows you where the different carbon trading systems exist today. Most of them are self-contained, and therefore the carbon cannot be traded from one system to another, though some now are opening up and making connections. It's possible to trade between the Mexico system and the California system and the Canadian system, etc., etc. So carbon is heading towards a situation where it would be a global fungible currency. And indeed, forecasts are that it will be the most traded commodity in the world. If we move forwards, Bianca, we can see the trajectory that the carbon price has within the EU emissions trading scheme has taken over recent years, where it collapsed post-financial crisis due to an over-allocation of carbon in the system, but has now risen up very rapidly, particularly post the Paris Agreement of 2017. And if we move forward to the next slide, we can see where the International Energy Agency thinks that carbon price could go. And what they've done here is provided us with 2 estimates, one based upon the world shifting to a 2-degree trajectory, i.e. policy and technology interventions put us on a pathway to 2 degrees, and one where we're not quite at 2 degrees, but we're somewhere between 2.7 and 3 degree trajectory. And so what we can see here for the European Union is in that 2.7 to 3 degree trajectory, we have a carbon price not significantly different to where it is today from the previous slide, $33 per ton of carbon 2030, rising to 43 2040. But the delta that sits between that number and the world shifting towards a 2 degree trajectory is incredibly significant, where we move to $100 per ton and then out to 140. This is defining for many business models, and indeed most high carbon industries do not survive that kind of carbon price change. And of course that's the intent, is that if we are to go to net zero, some industries have to disappear and be replaced by others. So as ridiculous as it might sound, that, of course, is what has to happen. And that, of course, needs to be navigated by a bank that's deploying capital into that system. So if we move forwards to the next slide, please. And we have a question here for Menti. So hopefully everybody's got their Menti system available. And the question is, how material do you think the carbon price will be for your clients? And I recognise you've all got probably quite different clients. So maybe if you can just respond by saying whether you think it's defining, whether you think it's material, or whether you don't think it's significant.
Great. And Bianca's going to show the slide now. For those of you who haven't yet logged on, it's the same system we used in Module 1. You can see the code at the top. James, while people are responding, there's a question that's come up, which I think is very valid. It's got a couple of likes, and it says the case for sustainability is compelling. What sense do you kind of have that COVID and Brexit could impact on momentum in this space? Do you think we're going to go back to business as usual? What's your feelings?
Yeah, it's interesting. I think the biggest driving factor around climate change will be the outcome of the US election, and that will be the most significant factor that influences the pace of change over the next 4 years. Brexit, COVID, not hugely material. To give you an example, the Biden administration has a $2 trillion Green Deal package ready to go if they win the election. They have the Climate Risk Disclosure Act ready to go if they win the election. That will mandate TCFD that we will talk about shortly. So right now, the US election is the defining factor, and not just for what the US does, but how that will then influence China, India, Indonesia, other major emitters. And we have the Biden camp looking to effectively go further than the EU camp has gone to date if they win, and reposition the US as the world leader in this space. There is significant economic stimulus tied up in that $2 trillion package, i.e. if you're building wind farms, if you're building transmission lines, if you're shifting your vehicle fleet from hydrocarbons to hydrogen, all of this requires investment. It requires jobs and of course creates stimulus. So I think the US election is the defining factor. COVID and Brexit. Brexit I don't think will have any impact simply because the UK government's already committed that it's completely aligned with EU on climate policy anyway. And the UK, as I'll talk about later, sees a decarbonising economy as an enormous economic comparative advantage for the UK. And I'll talk a little bit more about that in a moment. So what have we got? We've got defining and we've got material. Okay, so really interesting. And I think the answer to the question, of course, is it depends. It depends on who your client is, what sector they're in, and how they will be impacted. So there was no right or wrong answer there. It all depends upon the mix of clients I think that we've got represented in the room. So if we move on then, Bianca, just conscious of trying to keep to time. Yeah, so this is an example which is really included here in this conversation to help us all recognise that climate change isn't some future issue that will affect us one day in the future, which I think is how it's often tempting to think about it. This is E.ON and RWE, two of the safest places to have had your money invested since the Second World War, and yet they both declared enormous losses in the period 2015, 2016 and 2017. Unprecedented losses that prevented them paying out dividends and put their business model at enormous risk, with major questions being asked around how these organisations will fare now in a marketplace that has made a massive adjustment to renewables and left them with fleets of assets that don't have the right access to the market anymore, as renewables has been given preferential access. It's a complicated explanation to this story, but the big picture is this happened several years ago. It's almost deep history now, 2015, 2016. And therefore, please don't leave this session thinking, well, this is something that's next year or the year after. There've been haircuts taken by investors already on this agenda, and this is just two examples. We could spend the whole day going through others. If we move to the next slide, this is a very important slide. It defines or explains some of the very significant events that we've seen during COVID. Going back to that question that was asked a moment ago, let me just explain the slide first. If we burn all of the proven reserves, just proven on the balance sheets of the world's oil, coal and gas companies, we emit just sort of 3,000 gigatons of carbon dioxide. The scientists tell us that in order to stay within 2 degrees, we have of the order of 500 gigatons of carbon that we can still combust. So clearly, there's an enormous delta there, a delta that represents carbon reserves that cannot be burnt, not unless we introduce other technologies such as carbon capture and storage, which changes the economics of the asset. It's a highly inconvenient slide given all the capital that's already deployed into this. This slide was the slide that triggered the Bank of England's inquiry into climate-related financial risk way back in 2013 time. Which then triggered the G20 Financial Stability Board to undertake their inquiry, which I'll talk more about. And of course, it's the fact that this slide and the story in this slide has gained so much traction over the last 10 years that's led to, in the height of COVID, Shell, BP, Total, all coming out in April when there were an awful lot of much bigger issues to be managing in companies, all coming out in April and declaring that they are completely changing their business models and shifting to net zero trajectories. And some of you may well have seen the BP Capital Markets presentations of last week that went into a lot of detail around BP's perspective on a decarbonising economy, putting BP at totally at odds with the voice of the oil industry of the last decade. If we move to the next slide, Bianca. And just to share 2 different types of example really here. The top left-hand corner is the Model 3. Some of you might own one now. When I first started talking about the Model 3, they weren't available. Now they're all over the place. But effectively, an electric car that is basically, commercially viable for a family to purchase instead of a diesel, i.e. it has got to the point where it can compete. Bottom right-hand corner is Dogger Bank, the UK's largest offshore wind farm. The recent contract for difference auction led to developers bidding a price that was 20% below UK electricity market prices, i.e. the electricity here is being produced at a 20% discount to market price. And because of how the contract for difference works, the UK government will take that 20% as a revenue stream. The top right-hand corner and the bottom left-hand corner, they are not commercially viable yet. The top right-hand corner is actually a client of mine. This is a solar-powered road surface. It's a toll road in France, and that road surface generates electricity. Incredible. It's not commercially viable yet, but there's an awful lot of money being thrown at it to see if they can get it to that point. How disruptive is that to our entire electricity system if our road surfaces produce electricity? And the bottom left-hand corner, also not commercially viable yet, but that glass produces electricity. What if all the buildings in London could produce electricity with their glass? How does that change our energy system? How does that create risk and opportunity for those deploying capital into the system, particularly into an energy system where the returns on capital are over many, many, many years, and projects and assets are built with a 30, 40-year life expectancy? So some big disruptors there if they get through. The renewables market, very important for the UK economy. UK has an enormous renewables resource, particularly now as we're starting to move to the point where we can build floating wind turbines that are the size of the Eiffel Tower. That opens up vast swathes of UK waters that are too deep for conventional offshore wind. You can see here Morgan Stanley, they produced a report very back end of last year, forecasting 14 trillion of capex into the renewables market out to 2050. And what's also important on this slide, I think, is if you look at the European Union at the top, the bar chart reflects what current policies in the EU already will deliver in renewables. And then the green dot shows you where that will move to if we shift to a 2-degree trajectory. And what this bar chart tells you is the EU is already moving as if it was on a 2-degree trajectory. So in terms of policy risk around renewables, there really isn't any now because EU is already aligned with that 2-degree trajectory. Other markets in the world less so, but given your focus, that's an important point, I think. Next slide tells us about hydrogen. You may well have started to hear about the hydrogen economy and the emergence of hydrogen. The UK is currently working up a strategy that would mean that the UK exports hydrogen of an economic value that is greater than the North Sea oil was producing at its peak. That's because these floating wind farms, some of them will export electricity onto the UK grid. Many of them will be like the picture of the turbine on the right-hand side there, that has an electrolysis plant rather floating with it, producing hydrogen. And that hydrogen will then be shipped to markets. And indeed, much of the hydrogen that the UK would look to produce in its waters would likely be shipped onto the European continent as effectively a liquid fuel export. And this is significant. You can see Morgan Stanley here talking about a similar sum of capex going into the economy as that is forecast for renewables. This requires a carbon price to be economically viable, but we're already now seeing some very significant shifts into hydrogen, and indeed the big announcement around their pivoting of their business into the low carbon economy indicates that BP expects 10% of all the energy that it's producing into the market by 2030 to be hydrogen. If we move, So another quick question.
You broke up there
How
very
well,
briefly, James.
Sorry, Thomas, did you want to speak?
James.
Am I back?
You're back now. Yeah, carry on.
Okay. The challenges of Zoom style presentation. So we've got another question from Enti here. How well positioned is Lloyds for the emergent low carbon economy? How dominant are Lloyds commercial clients in these segments? So perhaps if I could invite people to respond.
Great. Thank you, James. And you've been speaking a lot about climate change, which is clearly there's significant commercial drivers around that. And a lot of the policy responses is around climate change. A few questions have come up around the idea of a just transition, and the need is, not only environmental or kind of climate change, but actually is much broader. There's also issues around kind of the just transition. Somebody mentioned kind of North Sea oil. What's the role there the UK going to do to support people in their jobs and transition to other areas of the economy? Any kind of reflections and thoughts on that?
Yeah, no, absolutely. I mean, I think the just transition is the conversation that always comes up when I'm talking with banks, because I think quite rightly so, banks recognise that they are part of a community, and that community's got to go through change. I mean, the North Sea oil, I think North Sea oil will be replaced by offshore wind and hydrogen, and probably carbon capture and storage as well. So North Sea oil communities will probably be net beneficiaries from this transition rather than net losers. But the question's still valid in the sense that there will be communities that are net losers here. Just as the coal mining community in the UK was 20, 30 years ago, for any of you that grew up in such a community as I did. There will be communities that suffer as a result of this. And certainly that would be something that as a bank lending into those communities, you'd want to be alert to. If for no other reason, I think there's lots of other reasons that there's risk to be managed there. But absolutely, and governments are alert to this, of course. Indeed, it's the political manifestation of those just issues that is complicating politics in some parts of the world today, and will no doubt play a role in the US election, where there are some large communities in the US that will be net losers from a decarbonisation, even if the US economy as a whole was a net winner. It's a really important issue. It's something that policymakers are very alert to, and certainly banks that I talk to and work with very alert to as well. So it's a good question. Thank you. So strong foundation. So in the middle, basically, which I guess is a foundation to build on. But it's a really interesting question, this one, actually, because there are some big incumbent companies that will navigate this transition extremely well. Okay, the jury's out on BP and Shell right now, but they've certainly made the move and expressed the intent that they will do that. But there are new entrants that didn't exist not long ago, that are extremely successful right now. Let's take Iberdrola, let's take Ørsted, two dominant players currently in renewables, that have emerged from different types of backgrounds. And so the question, I think, for lots of financial institutions is: are we moving our client base with this economic journey that's going on, or are we going to be left holding the hand of the ones that were high carbon and we hadn't transitioned? And of course, there's a mix there of ensuring you're building new clients as well as assisting your existing ones to make the move themselves. So let's move forward, Thomas, conscious that...
Right. Yeah, thanks, James. If you can trot through the next slides sort of in 5 minutes or so at most, and then we can come and have some good Q&A at the end, and I invite everybody to come off mute to ask questions directly.
So this is just a couple of examples on physical. This is a flood in Thailand. Why would that be relevant to the UK economy? If you look very carefully at the picture, you can see Honda appears on quite a few of those different industrial buildings. The floods in Thailand here prevented the Honda factories all around the world, including the UK, from operating for 3 weeks because of just-in-time supply chains. So we might not see the worst of climate change in this country in terms of its weather impacts, but even those that are occurring overseas can have quite material financial consequences to our businesses here. And of course, the next slide, of course, reminds us that we're not immune either, and we have had some pretty big events in recent times, and we've had some beautiful summers. Maybe we'll have more, but they have a consequence. I bumped into the farmer here where I live. I live out in the country this morning, complaining that haven't had rain for weeks and weeks, and it's starting to have a big problem for him. And of course that feeds through to banks that lend to that community, etc. So the physical risk piece can be very important. So let's just quickly now look at financial regulator investor response, which is very important, I think, as a driver for banks and the wider financial services sector. I showed you a slide earlier that I indicated the Bank of England had used to launch an inquiry. That inquiry was triggered by Carney, the then governor of the Bank of England. Around about 2013 time, I was quite involved with that process back then, and the Bank of England concluded that this could present systemic financial risk to the UK system. Carney was also at the time chairman of the G20 Financial Stability Board, the FSB having been established post-crisis to prevent another crisis. And so he triggered an inquiry at that level that became known as the Task Force for Climate-Related Financial Disclosures, or TCFD. And myself and colleagues advised that process as well, and we wrote the guidance that was issued on how to respond. But essentially, the exercise made a recommendation that all large companies should be required to evaluate what climate change means to their future financial prospects, and articulate that in financial terms, and express how they've integrated that into their strategic planning, and to do that annually. And we're now into that evolution, that journey of organisations responding to those recommendations. And so if we move to the next slide, what we've seen as a result of that G20 exercise is one by one financial regulators around the world now starting to mandate TCFD for financial companies. The first move was the Bank of England, the Prudential Regulation Authority, that mandated it for insurance and banks last April. The Financial Conduct Authority has a consultation paper at the moment to mandate it for all listed UK companies. The US have consultations running. In fact, I think one of their consultations concluded end of last week. The Canadians have a process in place which looks like Canada will mandate, not surprising given Carney's connections there. European Central Bank and European Banking Authority looking like they will adopt something very similar to the Bank of England. And the Network for Greening the Financial System, established last year to bring together all the different central banks and financial regulators across the key economies to bring some consistency to how the financial system is managed around this. And indeed, the stress test exercise for UK banks that Gary, I think, referred to earlier will utilise scenario data, a method that's been developed actually by the Network for Greening the Financial System. A good example of that consistency. So if we click on quickly, I think we heard earlier investors have made big moves, and we heard from James Wild around the impact of the Legal and General letter to chairman. The likes of BlackRock, Vanguard and State Street, the three biggest investors in the world, now all very vocal on climate risk. partly because they are largely leaning into a passive product space where they cannot therefore actively manage their portfolios and divest, and therefore they need to be very vocal in the market around encouraging shift because of the index orientated offerings that they have. But their influence has been significant because they are such significant investors in most listed companies. If we move on, and then just thinking about how organizations have been responding and how your organization's been responding, and I think you're going to learn much more about this in another session tomorrow, but essentially running risk assessment exercises across the lending book in order to understand how different pathways towards a decarbonising economy will affect the prospects of people you're lending to or organizations you're lending to, and therefore how you would want to factor that into your risk management system, your pricing, etc. And then finally, I guess the exciting piece to all of this, yes, there's risk, but of course there is enormous opportunity. And I guess the North Sea oil vis-a-vis offshore wind and hydrogen is just a classic example where one industry will decline and one will prosper. And the opportunity to be financing that shift. You know, I talked about 14 trillion into renewables, 13 trillion into hydrogen. They're just two parts of the clean tech journey. Enormous sums. And there will be a financial return to be taken on those that deploy capital into that space. So we've seen emergence of specialist lending products and offers, and I think Gary and James talked to that point earlier around how Lloyds has made enormous progress really over the last 2 to 3 years in broadening its offering and its capability in that space. So I won't dwell on that, and perhaps we move into questions, Thomas.
And a very pertinent point to end on there, James, that your slide that is, reminds us that change is difficult, but not changing is fatal. I think that's always a great quote. So I think we can come out of the slides now, and we've still got all three speakers for us. And James Wild and Gary have done a great job, I think, of responding to most of your questions via the chat function. Are there any other questions? And now's an opportunity to come off mute and let's have a bit more of a conversation about, anything that you've heard today, aimed maybe more at James Stacey, because he's obviously external to Lloyd, so it'll be a harder time getting back at him. We can always pick up on other conversations with Gary separately, but yeah, any other questions or comments or reflections you would like to make? I heard a hesitant mention there. Was that just somebody coming off mute? Well, while people are thinking of questions, I think we asked you, James, about your reflection around, COVID and kind of building back better. But maybe James Wild and Gary, you have some of your own reflections about, what does it mean for Lloyds in terms of your commitment to this agenda going forward? Do you think there's any sense of wavering? My sense is not, but it'd be good to hear your voice, your opinion.
Sure. I mean, my perspective is that that there are always going to be the clients that are disproportionately badly affected, and we made that our absolute priority in the early phases of the pandemic, and it will continue to be a huge priority as we go through the sort of subsequent phases that those clients will navigate through, from expiry of repayment holidays and discounted or interest-free periods, etc. But I think the thing that I draw great confidence from is, as I said in the presentation, just how quickly the conversation moved to green recovery, building back better, making sure that we didn't come out of the pandemic with more challenges by reverting to previous behaviours. I'm really sorry, this is a typical working from home moment. I have somebody at the door, so I'll hand over to James to offer a perspective. I'll say take that. I'm sorry.
No, I'd agree. I think there's a real focus on a green recovery, not just in the UK, internationally. I mean, a number of European governments have really invested quite heavily. The German government's a lovely example where they put 40 billion of their fiscal stimulus package into clean areas. The European Commission likewise is putting a significant amount of money against this. The UK to date hasn't put so much, but they're actively looking at it. We've been talking to the key people in the government. that are developing their kind of fiscal stimulus plan. And what's lovely is that the kind of green economy really leans in well to the need to recover. It has a good regional fit, as we've been talking about with the just transition. It creates jobs. It's very job intensive. If you're investing in energy efficiency, for example, it improves the productivity of companies and individuals at a difficult time. And it also helps us get on track for those targets. And I think what really reinforces this issue in the UK is that the UK is hosting the big international conference next year on the climate change negotiations. And it's really important that we have a great story to tell so we can lead by example, so that there's a need for the UK government to have a really clear plan as to how they're going to meet their net zero goal and fill all the policy gaps. And having a green recovery is a big part of that. So I think that really reinforces that case. And I was reading in the news yesterday, I think it was, that we're expecting announcements from Boris Johnson later in the year, November time, and they're already talking about bringing forward the ban on fossil fuel vehicles from 2040 to 2030. So there's definitely a direction of travel.
Great. So any other questions now that you've had a moment to think? Anybody else? There must be some questions out there. Don't be shy. This is your time now to ask any other questions about the kind of commercial implications of what you think, of some of these broader trends that kind of Tony introduced.
I'm really sorry about that, Thomas. Back with you now. You may already have covered it, but the one supplementary point I was going to make is just how important a role we can play in helping our clients to invest cost effectively, economically, in the right kind of activities of a green recovery that help to set themselves up better for the future. So I mentioned the green buildings tool and the fact that can help prioritize cost-saving initiatives that improve the sustainability of buildings, but that's a real opportunity for us, I think.
Thank you, Gary.
I have a question. I guess one of the key drivers of the pace of change will be consumer demand. So if I think about vehicles, right, consumer demand for electric vehicles and the affordability of them will drive some of the pace of change. What do you see as the big levers in speeding up that demand from consumers to switch to sustainable products? I'm happy for anyone to take it.
Yeah, I mean, I think we've seen we've seen an enhancement to that trend during lockdown to a degree. I think there's been a bit of a drive for localization. There's been I think increasingly people paying more attention to the heritage of the things that they're purchasing. I think EVs in particular continue to see a very rapid acceleration in take up, as James Stacey said in his presentation. My sense is there's just an unrelenting momentum which continues to build, and it's interesting to reflect on when we set out on this path just 3.5 years ago. That whilst we could start to see announcements by clients to manage risks or take advantage of opportunities, there was no Extinction Rebellion, there was no Greta, there was no Sky Ocean Rescue. So the real mainstreaming of these issues and people's appreciation of the urgency and importance of them, I think, has grown far beyond anybody's wildest expectations at that point in time. And I can only see that continuing, which it needs to, and is reassuring. But I'm sure, James, you've got some perspectives. Either James.
Yeah, I mean, look, I think a lot of the big consumer goods companies have been doing research on this now for a decade or more, in order to really understand purchasing criteria and decision making of the likes of us, and really for the most part, people want to buy something that's sustainable, but it has to compete on price. And whilst there will always be a small niche market of people who will prioritize sustainability above price, yeah, that's all it is. Then it's niche. It's not mainstream. And so There's been a little bit of research in the last 18, 24 months that challenges that and starts to suggest that there might be a shift. But I don't think you've got very many companies taking product to market at scale that asks for any kind of price on that sustainability from their customer. And of course, that's therefore been one of the major challenges of the electric vehicle industry to get to the breakthrough, particularly given that the lifetime savings come through reduced running costs, but there's a higher upfront price to pay. Obviously, a role for finance in that kind of situation. We saw last year, before COVID, the CEO of SAS, the Swedish airline company, come out and declare that their profit warning was completely connected with a whole new word now in the Swedish language, which is flight shaming. That was not price orientated, though I guess there was no price premium. People just didn't want to fly because they didn't want to be associated with the emissions that come with that. And of course, that has triggered in the aviation sector, one by one, large European operators declaring that they're now offsetting their emissions in order to eliminate that flight shaming risk to their business. Obviously, that's kind of disappeared into the background with everything that's happened in the industry with COVID, but was a response, I guess, from an industry whereby they have internalized that cost rather than necessarily pushed it onto the customer. But I think by and large, sustainability has to compete still, and I guess as we enter a very difficult economic period that we are and will be, I wouldn't expect that to go away as consumers come under pressure in their household finances.
Yeah, thank you. And we'll be hearing from Sue Garrard, who was the former executive vice president of sustainability at Unilever, which is a global FMCG company most of you probably know, and I think they definitely record that. I think they're kind of leading sustainability brands responsible for something like 70% of their growth in 2018. And they've definitely found at the consumer facing side strong demand, provided you meet on terms of your match on price and quality, really strong demand for products that have a good story. And I think in other areas of the economy, the traction might not be as good, like with housing, things which aren't kind of front of mind and kind of sexy consumer goods. But that's where I think, as James Wild was mentioning earlier, where you also then work with regulators and advocate for change to try to have more of a systemic shift. And I think Lloyds is already working in that sort of space to unlock where there's not currently consumer demand, what system blocks might need to be unlocked. And I think Lloyds is coming at it from both angles.
Yeah, and just a final thought on that point, actually, where we have seen price premium is where the sustainability benefits are one of several benefits as opposed to the benefit, and particularly where there's a connection between sustainability and personal health, whereby the purchaser will pay a premium because the product offers health benefits to them, as well as sustainability. And you can debate which was the driving force around the premium. I think the industry would say that it was the health rather than the sustainability, but certainly premium where the two can be put together.
Great. And there's a question in the chat function here, unless anybody wants to come off mute. Maybe Anthony, you can come off mute and ask the question directly if you're happy doing that. Kind of some of the challenges within the banking sector.
Yeah, hi, morning. Absolutely. I think it's just the pressure that we'll see in the competitive banking landscape at the moment. And I think all banks will pertain, and I think there's reference to Standard Chartered and HSBC earlier in this kind of space. It's the driver for us to, in order to deploy our balance sheet correctly, generate the acceptable levels of returns for our shareholders, versus differentiating that pricing perspective and enabling our clients to really diversify their strategy on the sustainability angle. I think a lot of clients, especially in the mid-corporate world where I'm operating in, get the benefits of it and really want to be able to report this green, the benefits of sustainable lending, sustainable borrowing, sustainable deposits, but ultimately it still comes down to the bottom line. And if a competitor is 30, 40 bips cheaper, they'll probably go with the competitor. And I think that's a real challenge we have in the world of banking right now.
Yeah, I think, well, I'd agree with your point. I think our plans in the commercial bank are certainly to build a more strategic pricing framework that reflects, lower costs for activities that in theory should have, or in practice should have, lower risk, rather than, the phase one approach, which was effectively just to take a modest discount on our margin in order to incentivize and support the right activities. I mean, it'd be good to get James Stacey's up-to-date thoughts on this, but I suspect that over time there'll be a stronger appetite for banks being treated differently on the price of capital for green versus browner activities on our books. But have you seen anything that kind of reinforces that more recently, James?
Yeah, I mean, so I recently acted as a judge on the Bankers annual banking awards, and specifically I was focused on the Sustainable Bank of the Year awards, which haven't been announced yet, but no, that'll come out in due course. But it was a very interesting process for me because I was able to review all submissions from the banks, and obviously I won't betray any confidence here, but big picture was how organisations that the best practice, if you like, is now making the connection between risk and product, such that you're not discounting your lending because it's a nice thing to do or because it means that you can tick a responsibility box. You're doing it because you actually know it makes jolly good business sense because the risk profile of what you're doing is lower, and therefore it's perfectly good business to be discounting. And also the plethora of new product that's coming out and some of the scale of that product that's now being pushed into the market, some of the case studies around sustainable linked lending, etc., on a completely different scale to that they would have been even just 12 months ago, really caught my eye. So I think there's that commercial piece, which doesn't answer your question, Gary, but I'll come to that next. But that commercial piece I think is really important, where there's the level of sophistication now in terms of the TCFD work, the scenario analysis, really understanding the risk profile of your client, and then how that can link to financing the transition, and how you can then price is one thing. That on the regulator perspective, I think you're right, Gary. Certainly the EU has been moving in that direction for some time, really, and obviously the taxonomy is a tool that will be or is expected to be deployed for that purpose. The German government was very nervous. You've probably seen it around just open the book carte blanche on a different level of capital ratio requirement for green. They were looking to put a ceiling on what an institution could do, i.e. a percentage ceiling, such that we didn't have a kind of runaway and potentially then inadvertently create a bubble somewhere else because of cheap lending at a massive scale. So I think that debate's still running, but I think the expectation is that what you described will emerge. Obviously, Brexit then might have an influence between different regulatory regimes, and will the UK then align or not, and what will occur there. But I think that's definitely the direction of travel, and clearly, some banks are experimenting internally in advance of an expectation that would emerge. And adjusting internal cost of capital to kind of mirror where they think the regulator might go, as well as doing it through good risk management, and the point that I made earlier.
Great, thanks, James. Which brings us on, I think, nicely with segue into our conversation tomorrow, where we'll look a bit more in detail at kind of climate-related risk and what the bank is doing on the task force for climate-related financial disclosures. So as we're bang on time now, I just want to thank the speakers, James and Gary. Thanks very much for inputting today and kind of responding to all these comments. I think we've had some good conversations. We will meet you back virtually online, probably, hopefully the same place, same time, so 10 a.m. tomorrow morning for module, what are we now? Module 4 tomorrow. So thanks for joining us, and please do engage in the online discussion forums. We'll be posting another question today, which for the week ahead. You can see that up there on the slide now, but that will come through a bit later this afternoon. So yeah, thanks again, and enjoy your days. We'll see you tomorrow morning.
Thank you.
Thanks all.